Hey guys, Ben Nash from Pivot Wealth, and today I'm here with Al Bentley. Al is the founder and CEO at Simply Wall Street, which is a platform that helps people with long-term investing research. They've taken the investor market by storm with almost 1 million users in Australia, which is amazing. And Al's background before he's been into computers and tech for a long time, but prior to starting Simply Wall Street, actually worked as a naval architect. So keen to hear how that transition happened. Al, thanks for joining us, mate.
How you going, Ben? Nice to be here.
Man, I thought a good place to start is just around what led you to start Simply Wall Street, particularly coming from a background in naval architecture. How did that all come about?
Yeah, I mean, I can tell the story, sort of for over an hour. So there's a lot to it, but I'll do the really short version. So when I was a kid, I was a real computer geek, and it was funny because computers are sort of somewhat banned in the house, but that only made things worse. So that when I did get access to them, I got pretty obsessed. But the computers that I had access to were the ones at school. And those ones didn't have any computer games on them, of course, being at school. So the only option was to write your own games. And so we just spent the entire time learning to program games and kind of trying to recreate the games that we saw outside the school on the school computers. So that was kind of like a crash course, but this was back pre-internet. And so that was kind of I guess you could say, my childhood and being a teenager. And when I came to go to university, I didn't want to study computers. I felt like it would kind of ruin it a tiny bit. So I went and did something else that probably I felt was a bit more real, more tangible, which was naval architecture, it's really just engineering for boats. And then after I was studying, and this was in the UK, I moved to Australia. I'm really big into windsurfing and surfing, and so I kind of knew I wanted to be somewhere I could do that. And I was working in Perth at the time, and pretty quickly I realized that whole industry, and just to be clear, I'm not saying that industry can't be disrupted. I think it certainly can be disrupted with technology, but I realized that all the skills that I had sort of learned when I was younger weren't being used at all in that kind of role. And it just wasn't a very, it wasn't a very entrepreneurial industry to be in. It was very much, this is your career path, this is where you're going. And so I pretty quickly, within a few years of working, had realized that I needed to go and be doing something in technology. And so I sort of started playing that. So I didn't last long in that industry. And one of the things I'd also been really fascinated by ever since I graduated was the stock market and how companies work, how businesses work, and investing in them. So I'd also been teaching myself that over the years, and I was really disappointed with what was out there. And it didn't really, you go and read these books that would advocate for long-term investing and why this was, really the best approach to take, and how it really simplified the whole investing in companies kind of thing, which on the surface to a lot of people seems very, very complex. But there was nothing out there that really helped you implement it. There was nothing that helped you actually go and do it. And most people, even nowadays, they'll go and read some of the famous books or podcasts, etc. But they're still stuck using Google spreadsheets and things like that to actually get it to work. Whereas what I wanted to do with Simply Wall Street was create a place that embodied those principles and actually had a product that supported you to do it. And so that was why I started the company. And it was this kind of obvious thing where I'd already started building stuff for myself to help myself invest. And I started to realize that there was a really big opportunity there. And so I quit working as a naval architect, and that's when I moved over to Sydney.
Nice. Well, you mentioned it's a common source of frustration for a lot of people around investing. There's so much noise out there, so many options, so much information. It's hard for people to know where to go, what's best. I'm keen to talk about how you guys do it at Simply Wall Street, but when you were in those earlier stages where you said that you were building up your knowledge around investing and how to tackle it, what resources did you draw on, and how did you go about learning for yourself?
Yeah, well, at the time, it was funny because at the time it was sort of pre-YouTube, right? So the whole way of doing it now has changed dramatically. But at the time, there was quite a, I would say, standard approach that people would go through. There was a sort of set of books, Benjamin Graham, things like that, that you were expected to read. Although if you've actually read those books, you realize that actually implementing it is still quite a big gap.
Mm.
And so I would say that my main way of learning was basically those type of books, so the sort of investing 101 books. Plus, at the time, the Motley Fool, which is really well known publication, and it's mainly in the US, but you have it here in Australia, and you also have it in the UK. They had quite a different approach back then. It was much more educational, and I would say more principles based. And that was at the time a very good source of learning as well, and that was good because it followed the market a bit more. So that at the time was very good for me. But again, it's just content, right? You can read all this content, but it's still up to you to go off and figure it out on your own. And ultimately, as an investor, you're gonna have to take the plunge at some point, and you're probably gonna have to make some mistakes. It's very unlikely that you're going to be able to invest and just get everything right from day zero, even if you think you've learned everything. Sort of break investing into three stages of learning. First stage is learning how companies work. So the majority of investing, or as people think of it, is not learning to invest. It's learning how businesses work. It's learning how a business functions and how a business grows. And some people are lucky enough to learn that maybe vocationally through their studies. But if you haven't done that, you still need to go and learn about those things. And to most people, that's quite fascinating because it's quite useful to know that anyway. Then there's taking that and turning it into the investing aspect, which is how much could this company be worth, and should I buy or sell it? So there's a sort of investing aspect on top of that. But then the final one is then putting that all into practice and learning about the mistakes of, I thought this business was going to grow into this market and I was wrong. So I sort of break investing, the learning journey, into those sort of roughly those three stages. And that last stage never stops. There's no investor in the world who's saying, I've learned everything. I know everything there is to know, because you're always learning about new businesses and new companies.
Yeah, totally. And I think in the early stages, and I know I certainly made a bunch of mistakes, that there's a few lessons that you sort of need to learn by doing. And sometimes you go through this tipping point where you know enough to be a little bit dangerous because you're probably a little bit naive to some of the things that you should know. You make decisions based on what you do know or think you know. And it's one of the things that I say to people is, particularly in those early days, sometimes starting small, fail, because you probably will make some late learnings, make some mistakes, lose a bit of money. Thankfully for me, I was at uni when I started my investing, so I didn't have that much money to lose. But you want to sort of tread carefully in those early days as you are learning. Obviously, Al, we're in this super weird time at the moment, coming out the back of COVID, which was strange enough, and then what governments have done around the world, and economies and companies, and now interest rates and inflation. What's your take on that in terms of the impact on the share market and where the world is today?
Yeah, I mean, I think that everyone at this point in time is feeling, this is unprecedented. We haven't seen this before. World events are changing. And I think one thing we can say is that world events will always change in an unpredictable way. So the best thing to assume is that that's just going to continue, and prepare yourself for that rather than expecting to be able to preempt anything. I would really come back to the idea that for a long-term investor, and long-term being in really ideally in decades, then markets correcting themselves is normal and expected. And if anything, what was unexpected was having a bull run of 13 years, which is what we've had leading up to this sort of correction now. That was a very, very long bull run that went on for longer than people probably thought. And now we're seeing a correction, and this situation, of course, there's some geopolitical things that are unique about what's happening now, but broadly speaking, it's effectively inflation, and people are trying to get inflation under control, and that's happened before. So for most investors who have that long-term view, this type of correction is normal. You would expect it in any stock portfolio, and you really have three options. You can either say, I'm going to try and sell out and somehow, I don't know, time it and buy in again at the bottom, which generally I think is quite risky, if I would say so. It's very hard to know when that's going to happen. Or you just sit back and let it happen, let you ride through it. Or you might say, well, I'm just going to keep adding. I'm just going to keep investing through this time. So most long-term investors, I guess what's unique is that anyone who's invested for more than a decade would have seen something like this before, and they'll say, yep, that is part of stock investing. And what is not normal is just a super long bull market that goes on forever. So yeah, that's kind of how I see it, I guess. And it's very, very hard. You've got to remember the vast number of new investors who've come in say the last 5 years, which is what we have seen. You've got new technology, you've got all these new apps, very low cost brokerage, fractional investing, everything. It's effectively easy. It's the easiest it's ever been to access the markets and the US market, by the way, now, so that everyone can access it and they can do it cheaply. So you've got a lot of new investors coming in, and for a lot of them, this is their first correction, and they're probably figuring out like, hey, what do I do? So it's easy to say, oh, be long term, but if you've only just started investing the last few years and this is your first time that you're seeing this.
Yeah, totally. We talk to a lot of people that are really in the last sort of probably that 5-year period that you mentioned started hitting their straps from a wealth and savings perspective. And then you go through this part where you save a bit of money, then you realize, oh, I probably got too much in cash. I should do something with it. I should make the money work, then start going in. And yeah, unfortunately, from a timing perspective, hasn't quite worked out. And they're thinking that might be the norm. In some ways, perhaps it's a good thing in that they're, for other people that started investing 5 years ago that saw it come up, now they're going, hold on a second, what's going on here? Whereas when you start and realize that it's down, it forces you to really think about what you're doing and make sure that you're confident in the decisions that you are making so that you can follow it through. And I think that serves you well in good times as well as in bad times. But I think that saying that time de-risks all risk does tend to play that. Who knows where the market's going to be a month from now, 6 months from now, or even a couple of years from now, but where it's going to be a couple of decades from now, I think we all know, as long as capitalism continues to reign, then companies keep making money, that the share market will be up. What are some of the trends? Obviously, you got a lot of people on your platform, and you see what different sort of segments of people and cohorts are doing differently. What are some of the trends that you're seeing from investors at the moment?
Yeah, we're broadly seeing two types of behavior from stock investors. And one is people kind of going on pause a bit and just saying, hey, I just want to see how this whole thing plays out. And I'm just going to, they've still got their portfolios, and their portfolios, might be down a bit or not doing as well as they were a year ago, but they're just on hold. And then you've got people who are saying, finally, yes, these companies that were so expensive before are now affordable. This is the best time ever, which is like walking into a store and everything's half price. And so I feel like you've kind of roughly got those two people. At least from our platform, you don't see a lot of people who have like, as you might say, sold out of everything. Which is, like I said, quite an aggressive approach. I'm not saying no one's done that. I think some people probably have done. But yeah, I think generally you're seeing people either pause or say, oh, this is great. There's all these amazing companies. And as you said earlier, like when people have started investing, one of the most common things that they'll do is they'll either go in on like hype, either hype companies, or it could even be hype other instruments, crypto, whatever. And hype's dangerous because everyone gets behind it and the hype builds. And, again, I'm not saying it's not possible to make money on that. It probably is, but you have to become a hype predictor effectively to be able to trade that. And that is trading, by the way. And then when those things come kind of crashing back, a lot of people then learn a hard lesson, which is why a lot of long-term investors like to have companies with good fundamentals, which is their companies, they are profitable, they serve a, they solve a problem for customers, it's something that's important to people, and those companies aren't going anywhere. They grow on their own. You become a shareholder in that company is growing because it's reinvesting its profits. And that's just the basis of sort of fundamental investing. And people who've read books like Rich Dad Poor Dad and things like that, it talks about buying assets. So that is an asset. It is a growing asset. And a lot of people, after they've learned that sort of hard lesson, will come back to that again and be like, cool, well, how about I just buy companies that I really like, that I know are growing and will be there. They will be there in 10 years, and that's quite a different mindset to, oh, this is the next, I don't know, just to use an example, but this is the next exciting coin. If I get in now on this coin, it's going to go up 1,000x, type approach.
I think people, it's because there's so much psychology that impacts how we invest, and it's completely natural that when you go to make any sort of investment or do anything basically in life, you want to get the best outcome possible. So when people think about where do they put their money, they think, oh, well, I want to get the biggest return. But people don't always sort of line it up in their head to think that if you're expecting to get some supersized return, then you've got supersized risk. Like there's enough people in the world that have a lot of money that they keep the markets honest. So without getting into, the technicalities of the efficient market theory, it's like, people, there's no free lunches here. So if you're thinking you're going to get that 1,000x, then you've got 1,000x risk. And that's similar with the trends and those hype things, and even crypto. And I like crypto. I think it's got a future. I think it's got a good future, but the return is crazy volatile, like we're seeing at the moment. And yes, you might get an extra few percent or 5% or 10%, but you are coming with the risk of facing periods like the one that we're facing at the moment. And I think you would know as well as I do that when you run the numbers and go, boring compound investments, like the big blue chip companies, stable, they're banging out their 9% or 10% year on year, that creates an amazing amount of money from just a small amount of money. Like you don't need 15% to get rich. You just need to keep, following the bouncing ball and putting your money in while market conditions are there. And I think that's these people. You mentioned people sort of holding fire and pausing in the market conditions. And I think, obviously this is not advice, and absolutely there is a case for people to stop. Like there's a reason that there's smart reasons that people should be stopping investing now. But if investing was the right play for you 6 months ago or 12 months ago, and then the market conditions have gone down, that stopping probably doesn't make a lot of sense. You want to keep going, if anything, or ideally be putting in more, so that then you're buying in at these discounted shares at a cheaper price. And when markets recover, that you're going to accelerate on the upside. So I see, like, particularly with interest rates being as low as they've been over the last little while, that people are saving up for house deposits and they want to buy a property in a year or 2 years, but they don't want to leave the money in the bank account, especially when inflation's 6 or 8% and interest rates are 1 or 2%, that they're going backwards. And yes, it's never good to see your house deposit go down, but if you do keep just putting in, and then when the markets recover, you're going to have a bigger deposit, buy a bigger house, or have a smaller mortgage. So I think that what people, in my view, when market conditions like this happen, and particularly if you're stressed or concerned or questioning your strategy, you should go all in on educating yourself around what you're doing and why, and making sure that it fits. But you probably find that when you do that, if you do it well, that you're probably investing well. If it was the right move, if it wasn't a mistake 6 months ago, then stopping is probably a mistake now. I wonder, from what you see at your end, for people that have, because you would see some people that are just early on in investing, or some people that have been at it for a while, and some people that have more money and less money. Are you seeing different trends for people in those different groups?
Yeah, I mean, I think the biggest trend is that the people who have those larger portfolios, and you might be lucky, but you generally don't build up a large portfolio overnight, right? It's generally something that has built over years of contributions. And so I think generally the people that have just come in, who have a smaller portfolio, are more likely to be the ones that are pausing and saying, I'm out of stocks, or I'm gonna sell my stocks, and as you said earlier, maybe convert that to cash and do something else with it. Whereas people who've built up those portfolios, like I said, they've probably been waiting for this crash for a while. They've almost been hoping for it to come in some sense, so that it's like it is a correction. It's what you'd expect. It resets. It's certainly resetting the way people think about, for example, technology companies. And a lot of people have been saying before that this is unsustainable. This is not normal. And I mean, those people turned out they were right. So I think people with the larger portfolios who've built that up over the years of contributing to them are the ones who are going to keep going through this cycle, as exactly what you said earlier. If you were investing 6 months ago, it is odd to stop now, although obviously you still need some money to invest.
Yeah, absolutely. And I think you mentioned changing view of tech, which clearly tech is a huge favor, particularly for young people. We've got a lot of tech, like as an industry, a lot of people working in tech at some of the bigger players for younger people, a lot of engineers, obviously pretty attractive. So I think it has changed the view, but interestingly, it's changed people's view of resources as well, that these resource companies, and you can put the social, I suppose, or socially responsible element aside for a second, but people like resources were out of favor because they're boring companies that are doing boring things. And now we're seeing resources are surging and they're the ones that are performing best, and tech in the tank. So I think it's a good reminder for people that if you want to smooth out your risk, that having balance is important. And particularly for early on investors, we see them that they're so tech heavy because they've got these really interesting companies, companies like your company, like super interesting, that people are, they want to get around it. But when you're all too heavily weighted, then you are going to be subject to more volatility. You guys, obviously, with what you're doing, you're at the core of it, it's analysis of companies and looking at businesses to help people buy individual stocks or figure out what the right individual stocks are that they should be investing in or could be investing in. And that's obviously that's a method of investing that's been around for a long time. In the recent past, though, as we're seeing the rise of more managed funds, ETFs, M funds, like more products that have that are not individual company stocks, that it seems like a lot of people are going down that path, and we're seeing those markets growing while the broad investment market is growing as well. But what do you think, like when is individual company stock investing, when is that better, or when should people be looking at that relative to or compared to like ETF or managed fund type investing?
Yeah, it's a great question. And I think just to be clear, that so Simply Wall Street is there for people who want to start building an individual stock portfolio, right? And generally, an individual stock portfolio is something you actively manage. You build it yourself. And again, that's also important with Simply Wall Street, is we're not telling you what to buy, right? There's lots of other services that try and do that. So you're still the one making the decision. Ultimately, as an investor, that's the muscle that you need to flex and build, is your decision-making muscle. So you need to go and make those mistakes and get better at your decision-making. So I just want to be clear on that we're not a place that recommends, hey, buy this company. But in terms of, funds, ETFs, things like that. So first of all, the majority of those, are designed to be passive. You're right. I know that not everyone uses them passively, but they're designed to be something that you don't have to manage. You just sort of buy and forget about it. And so, and that's awesome, because that's what we would always recommend, is before you dive into looking at maybe owning shares in a company, the first place you should start is the passive part of your portfolio, right? And you should start building that up. And that shouldn't be too complex, because as you said, once you're doing it, then it should just keep going. It should just be passively there. You should not be trying to overthink it, right? We're kind of lucky in Australia because we have superannuation, and superannuation sort of acts like that. Like every time you get a paycheck, a percentage is going into some kind of fund. Although, of course, as you know, the different super providers have a slight different mix, but broadly speaking, you are going into a fund. Most of those ones try to match the market, although to be honest, it would often just be better if they just went into an ETF. Um, and so that's already, we're quite lucky because in some sense, everyone gets that part of their portfolio by default. Although again, I personally would advocate for doing further passive investing on top of your super, because obviously your super you can't access. So I still think that's a good place, just to building it up. But again, I think the important part is it should be passive. Really, it shouldn't be trying to be like, oh, I'm gonna go in, today is the day type thing. And the other great thing is you've got a lot of these products, these ETFs that are thematic, so that they're, if you want to go in on a certain theme, then you can just go buy the ETF, and that also simplifies things a lot. Again, broadly speaking, it should be passive. It's very much, well, that's the thematic I believe in. I'm just going to go and buy the entire thing. So then the question is, when would it make sense to actually start to consider, I'm going to buy an individual stock, right? And I think for a lot of people, it needs to be clear that if you're not interested in doing it, and you don't, to your point earlier, want to take on the additional risk for that additional reward, then you don't need to. It's not a requirement to do that, right? But I think that what it does allow you to do is to say, for example, if you did work in an industry, let's use tech, right, as an example, you might say, hey, I know this industry really well. I don't know, for example, let's say it's cloud providers or cloud security or something like that. I know this industry really well. I know the companies that have the best products and the best run companies, and I would love to become a shareholder in this company and participate in its growth, right? So that is the beauty of the stock market, and the beauty of the fact that nowadays it's not an elitist thing anymore. Anyone can go and buy. You can go buy $50 worth of a company now, which is amazing. So, and that's the time that I think that starting to say, no, I think I want to be a shareholder in this company, and no one's stopping you do it. And I think that's excellent. And I think that for people who are interested in doing that, who want to take on that additional risk, then that's where Simply Wall Street comes in. Is we're trying to help people get into that mindset that they're becoming a shareholder, and we're trying to help them understand that they're buying it. You're buying a business, right? You're buying a business. You're becoming a shareholder in a business. What does that business look like? How is it going to grow? And trying to get people into that long-term thinking, right? And so, and the other way that can work as well is if you're quite passionate about, if there is, say, an industry, let's say you mentioned resources earlier, right? Let's say you're very passionate about something with climate change or something with moving to EV or whatever it is. Again, you can go and buy a fund to do that. When you actually look at the funds, they're usually quite broad, the things that they'll consider relevant. Right. And you might say, well, hey, I don't really want to own that company there. I don't think these companies are the right companies to own. And so then you might find it easier to just go and say, well, I'm going to instead pick the ones that I think are relevant. And, for example, lithium in general, you could argue is slightly hyped right at the moment because of the move to EV. It could be justified. You never know. Tesla was a hype stock years ago, and turns out that it was a justified hype one. They pretty much have delivered on what they promised. But when you actually sort of peel back the layers of that industry, you know that it's not so simple. It's not just lithium. It's not just lithium mines. It's much more complicated than that. There's much more to the industry than that. And you can choose any part of that industry, any company, and you can become a shareholder in them. And so again, it lets you have that participation, and lets you take on that additional risk for potentially for rewards. So that's really what stock investing is all about. And I very much see it as a building game. Like, I'm building up my portfolio. I'm like, oh, I like this company. I'm going to own a bit of that one. And personally, for me, I'm sort of like a passive active investor. So we're not suggesting people obsessing and spending hours and hours on this. It's something that you add to over time. You keep growing. So yeah, that's how I see the two.
I think one of the things that you mentioned there that I think is a major advantage for individual company investing is, particularly if you've got a like an ethical or you want to take a socially responsible investing approach, that it can be quite difficult because what is ethical and what is not ethical is very much a subjective thing, and it comes down to your values. Can be really difficult, and we find this with clients when they tell us what's important to them and what they want to avoid and what they like to support. can be really hard to find those through a direct fund themselves. Whereas if you say, well, I believe in, you say electric vehicles, then you can follow something that goes directly into that, and you're not getting mixed in with a whole bunch of other stuff. But broadly as well, I think that one other advantage of direct stock investing is that you do build your money muscle, your investing muscle, your money knowledge a little bit more, a little bit faster as well, because you are getting more direct exposure, and you're forced to just connect the dots between the economy, the headlines, the stock performance, and those sorts of things as well. So I think you're absolutely right that if you don't want to, then it's probably not right for you. Like if you're not excited about investing or excited about learning investing or spending time on it, and you're super busy, and like we, a lot of us are, then it can become a bit of a challenge and potentially a problem if you're not giving. Not that it needs a ton of attention and time, but it does need a little bit on a regular basis. So you want to make sure that you're getting that right. Al, my last question for you is, what's the one mistake that you've seen investors making that you that sort of burns you up, that you think people should definitely avoid when they invest?
Yeah, I think that's a great question. I would say, so first of all, I would say you should expect to make mistakes as an investor, and the best investors learn from those mistakes. And when they make that mistake, they say, well, what can I learn from this, right? What did I get wrong, right? Maybe my understanding of how the company worked was wrong, or maybe I thought that the industry was going to do this and it didn't, or whatever it is, right? Great example could be, I don't know, buy now, pay later. So for anyone who did buy into one of those companies, right, what has happened since then? What have they learned, right, about that? So I'm really treating each decision as a learning exercise, rather than just, it didn't work, and the reality is that's often what moves people from becoming a kind of a follower, right? So someone who invests just by following other people, so tips from their friends or just recommendations. Because the problem with being a follower is you don't learn from following, because you were not the one who made the decision. So you don't really know, such and such told me to buy this and it didn't work out. Well, all I learned from that is not listen to that person again, right? So that's why that sort of self-learning journey becomes important. I would say the one mistake, though, to answer your question, is when you are starting out and you are looking at buying an individual company, or I guess any kind of risky asset for that matter, is to seriously avoid that temptation to go all in, right? And that you do see people do that, and that is by far the biggest mistake. And you can understand psychologically why people think that that's a good idea. They get so convinced, and their conviction becomes so high that this is going to be life-changing, et cetera, and that is by far the biggest mistake. And as you can imagine, a lot of people can get very burnt by that, and we see that in the stock market, especially with very speculative stocks. People sort of think, yeah, this is going to be the one, and it's kind of almost, I would say, borderlining on just lottery type mindset. But you also seen the same thing with crypto, unfortunately, especially people who bought in at the peak hype, if you will. So that is the biggest mistake to avoid, because you don't need to do that. You don't need to put everything, or I'm going all in on this. You want to learn, you want to start practicing. But the good thing now, like I said, especially with regards to stocks, is you can just buy in really at such a low cost, and you can build up from there. So I think that it does make a huge difference to use real money. You can do sort of virtual trading and stuff, but I'm not saying those aren't useful to understand the mechanics, but it's only when it's your own money that you start to have to learn to deal with your own emotions, and that's kind of what you learn. So it's also what you're learning. So yeah, to me, that would be the biggest mistake that it would be great if we can help more people avoid, which I like to think that we do at Simply Wall Street.
Totally. And these days you can start with as little as 1 cent in some of these micro investing platforms. So you can put a bit of skin in the game, not going all in, but getting that exposure, and then you start to see what's actually happening. But I think nailed it there, that it's really important. Everyone's going to make mistakes with investing, as with all other areas of your money. But if you're not doing a diagnostic when something goes wrong and figuring out why it went wrong so that you can avoid it happening again, you're just setting yourself up for more failures in the future. And as I said a couple of times, it's a muscle that you build over time, that you've got to learn those lessons and take from them. I've definitely learned a few through the GFC, that some investing. And when I was early on considering myself, I'd studied like 3 or 4 units at university. So by that time I thought I was definitely an expert. And, you pick up a few things as something blows up and doesn't work the way that you want. And, but that all allows you to grow on that investing journey as well. Al, for anyone that's interested to learn more about what you guys do or what you're about, what's the best way for them to do that?
Yeah, just Google Simply Wall Street or find us on any of the app stores. It's completely free product, so anyone can get started and just go explore, go on the learning journey and enjoy it.
Awesome, mate. Well, thank you so much for sharing your insights. It's awesome to watch you kicking those goals. So look forward to continuing to follow along, and we'll catch you on the next one.
Thanks a lot, Ben. It's great to be here.
Cheers, team. We'll catch you next.